Hey, my name's James Nicholson and welcome to my YouTube channel. Now, we have made a lot of videos recently about property prices crashing. But today, I want to talk about what happens if the market doesn't crash. Is that a possibility? Let's discuss. So we're going to jump into that video right now. Make sure you stick around to the end because this is something that I really want to get the debate going on. Do like the video, guys, subscribe to the channel and hit the bell. Make sure you check out all the other content. Now, look, the market is in turmoil at the moment. You can speak to any estate agent and transactions are definitely down for sure. In fact, we've had 4 consecutive drops on a month-by-month basis at the end of 2022. Now, why did we have those drops? Well, look, effectively, property will always have some sort of correction. That's just normal, and it has happened historically for hundreds of years. Now, the last few years have been absolutely crazy, haven't they? We had obviously the pandemic. When the pandemic hit, it made logical sense that house prices would go down. That's what everybody assumed would happen, and I did too. But it didn't. In fact, the opposite happened because we wanted better accommodation to live in because the threat of another lockdown really worried a lot of people, and they wanted to make sure that they had somewhere good to live. And so certain areas did really well. I was fortunate enough that many years ago I invested in Hastings in Sussex, and that's near the beach. That is at the beach. And so a lot of people wanted to go to areas like that. Now, there was a drop in London, but the home counties and everywhere else pretty much did quite well. And so we then had 2 very, very strong years of house price growth, and that's not sustainable. So whatever happened, the market would have had a slowdown 100%. Like, that's an absolute given. You can't go up more than 10% per year back-to-back years without something giving. So that caused a slowdown. Now, the pandemic also had a knock-on effect on lots of other businesses. So the government at the time printed an absolute ton of money. They gave that away to the bounce back loans, the furlough scheme, and all these other wonderful schemes that kept business going. And that was important that they did that at the time. Otherwise, we would have been in a way worse situation than we are today. However, coupled with the war in Ukraine and shipping and all these other problems and supply chains having issues from China, we have like really, really high inflation that we've not seen since the 1970s. So inflation peaked out at 11%. And what we would normally do then is raise interest rates above that level in order to bring that inflation down nice and fast. However, we were at pretty much 0 interest rates. So it wasn't really an option to do that. Also, a lot of the inflation was caused by things out of our control. I mean, we can't dictate when stuff comes in from China, can we, as a normal person on the street? And so they had to raise the interest rates, and we're currently sitting at a 3.5% base rate. Now, back end of last year, Liz Truss took over, and Kwasi had the budget, and the budget was an absolute disaster. In fact, the predictions off the back of that budget were that the interest rate, the base rate that we get from the Bank of England would go to 6.5%, right? Now, that's not good. If you are a buy-to-let investor and you're paying interest only, for some people, that could mean that their payments could triple or quadruple at the time of remortgaging. And so that is really, really not a great situation to be in. So that was where we were looking at ending up. Now, as you know, we've got a new Prime Minister. Liz Truss didn't last very long at all. So we've got Rishi Sunak in now. And so the markets are a lot more calm. And they believe that we're on a better track, not the best track maybe, but a better track than we were. So they predict that the interest rates will peak at 4.25% as a base. Now, you'll get a rate from a bank around 2% on top of that. You might get 1.5% on top of that if you're lucky. So that's considerably higher than where we were. Now, what that means is affordability is considerably less. So if you're buying a property, they're going to look at what are the monthly repayments that you've got, and that's going to be a determination in how much you can borrow. Now, normally it goes just off your salary, but the actual payments are a very big part of that consideration as well. So you might get 4 times your salary, but if now because of interest rates the payments are £3,000 instead of £2,000, that means you're not going to be able to borrow so much money. Now, that means that people buying will not be able to offer so much money. So logically, that means that prices should at least even out till we catch up with that or drop. Now, a few things that have impacted this is a lot of people have got very, very good pay rises recently. And another thing that's going to potentially stop the market going down as fast as some might like is the fact that the buyers aren't ready to drop yet. They're just not looking to drop their prices. Now, I know some of you are going to say on Rightmove, you can find lots of reduced properties. That's normal. That's totally normal. The last 2 years, you haven't seen that because we've been in an absolute boom. Rightmove have said themselves, there is always at least 25% of the market that is reduced. At the moment, it's not quite there. It's around 20% of the market is reduced. And some people brought their properties to Rightmove in the last few weeks at higher asking prices than were first expected. What that shows us is that those sellers are not desperate to sell. You see, if you've got $100,000 house, you've cleared your mortgage off maybe, you're not going to be desperate to sell that property if you don't need to. And so they've raised their prices. It's the asking price, to be very, very clear, not the sold price, but it just shows that until people are willing to take those price drops and reductions, the market isn't going to move anywhere particularly fast. And that means that the market might not crash. I've said might there because I know you're going to hammer me in the comments for this, but it might not crash as fast as people are expecting. Now, what do I think is going to happen? I think prices are going down in 2023. Of course, they're going to go down. January, we'll get some data and it will tell us that the prices have gone down in December on completions, as they did in November and October and September. That's going to happen, but it will slow down. It's not going to be another 2.5% and another 2.5%. You're not going to get back-to-back big drops. I don't think we're going to get a 5% drop in a month. Looking at the data that's out there, it's showing that asking prices are up, transaction volumes are down, so there are less buyers in the market, and the government has put some schemes in place. They put the mortgage guarantee scheme, extended that. That's going to help some first-time buyers get into the market. So there is still some good stuff out there. Halifax and Nationwide, they're saying that we think that we're going to get a soft landing now rather than a crash. So what does that mean? Well, if we don't have a property crash and we've still got record inflation, the price is actually gone down anyway. So even if you've got a $100,000 house and we still stick at 10% inflation all year, the house is actually worth less without the price going down anyway. So that's kind of another way that the market is going to be correcting through 2023. So possibly the prices won't crash. And what I think would happen in that scenario is that we would have a couple of years of almost no growth at all. 1% up, 1% down. Very, very little movement either way. That is a correction. If we keep going with inflation and it's still high, that in itself is a correction. People are getting pay rises. So once the market starts recovering next year or maybe 2025, that means that they will get that affordability back, and that will help. Interest rates even, are in America are expected by the summer to start dropping again. The Federal Reserve, if you read about it, is potentially looking at a U-turn. Now, they can't go out and say we're going to drop the rates because they're likely to go up temporarily first, and they can't tell you what they're going to do in the future. But if you read about all the data about the Federal Reserve, it looks like they may have gone a little too fast with these interest rate rises. I don't know what's going to happen, but I'm just putting it out there. What is the scenario of the prices not crashing? I think that that's definitely a possibility And I think if that happens, we will have just some very, very, very slow years leading off the back of that. And that's fine too. It gives us a bit more predictability. But whatever happens in the market, there are always great deals out there. So go and look for those deals, because you can buy 20% below market value. So even if the price drops, you can still be in a safe place. Look for properties that need work done to them so you can add value as well. That's it from me. Let me know your thoughts and comments on that. Do smash this like button, guys. Check out all the other content on my channel, including this video right here.